So this is the office hours for Monday, April 12th. So questions?
Could we do an example with the full model?
Mm-hmm.
There's still some things that, well, yeah, a lot of it is confusing me right now.
Okay.
The part that confuses me the most is the labor, part.
Okay.
Is that part of it.
Right. So
Okay.
let's, and I heard you say something before about question about business cycles that I can tie in here as well.
I think that's just I mean, in the economy there will always be ups and downs with expansions and contractions, and that pretty much is the business cycle.
That's correct. That's been the experience. That is the theory, that there will be business cycles, and that's just a natural part of capitalist economies.
And it's called tread. A tread would be from what, an expansion to a contraction?
Trend.
A trend, yeah.
So the other part about capitalist economies, right? So one thing is there tend to be, capitalist economies experience business cycles, periodic expansions and contractions in a lot of different sectors, variables, areas of the economy that tend to move together. Right? Ups and downs. And those ups and downs are caused by shocks to the economy. Something happens to knock the economy off balance. Could be in a good way, right? We don't normally think about being knocked off balance as a good thing, but there are shocks that can move the economy and cause it to really heat up and expand faster than sort of the long run trend. Or there are things that can happen in the economy that negatively affect the economy, like coronavirus pandemic, for example. But it could be that consumer confidence just starts to falter for whatever reason. We don't necessarily know. Or there is a downturn in the stock market. Now, normally we don't think about the stock market in this course, and stock market isn't economic activity, but yeah, it's linked. It can be, not always is, but it can be linked to economic activity. So if there's a downturn in the stock market because maybe there was a bubble, right? There was some financial bubble, right? Or in the housing market, another one, right? This is the 2008-2009 recession, right? Where banks were, a variety of things came together to cause the problem. Banks were making loans to people who, with easy credit, easier than they had previously, people who then bought larger homes than they probably could afford, or they could afford as long as things were going well, right? Maybe. But if there was any kind of hiccup in jobs, unemployment, recession, then they were going to be in trouble. And so people at the margin that otherwise may not have gotten home loans, for example. Then there was insurance. There were new markets that bundled those mortgages up and sold domestic securities, mortgage-backed securities, insurance on those securities, another industry that came into play. And it was kind of a house of cards a little bit. And so when something happened to slow down the economy and people start not being able to pay their mortgages, right, then the bank forecloses, but there are mortgage-backed securities backing those, that they start to default, and insurance on those mortgage-backed, they start to default. There's not enough money to pay off all the people who are losing money, and that was a downward spiral. So people are losing their homes, their wealth, right? Well, homes are one of the biggest sources of wealth for people. Not the only, but it's a significant one. right? Savings for retirement, 401ks, those are important. Those are also really important, right? But oftentimes real estate, homes, residential investment, right? And going back to chapter 2, homes, new homes or homes are a big part of that, right? So there's some shock to the economy that causes the economy to get out of equilibrium, to get away from full employment. And then the question is, what happens? How does the economy get back to full employment? Right? That is the key. That's the question. Separately, there's this question about the long run growth trend in the economy. Those ups and downs in the economy don't just go along a path where real GDP is staying the same long run, right? Living standards increase over time. In other words, potential real GDP, the amount of output you could get with full employment increases over time, or that's been the case. Question is whether that is slowing down or whether that will continue to increase.
Is that because technology increases over time?
That's part of it. Yeah, that has to do with that production function, right? It has technology increasing. Yep. Schooling, right? More universal schooling, right? So one of the big things, labor force participation rates. So one of the big things historically was a movement from agriculture to manufacturing. So with productivity, with increases in technology and productivity, you didn't need as many farmers to farm the same amount of land, right? New tractors, new planting techniques, etc. Right? And so that freed up labor to work in the city. People move in the cities or towns, etc. Not on the farm, not farm production. So there was a significant increase in production and productivity in the overall economy. In that case, following World War II. World War II saw a big influx of women into the labor market. The labor force participation rate of women significantly increased during and after World War II. That continued through the 1960s and 70s. So previously, women's labor force participation rate was much lower than men's, right? And so that's a boost in labor supply, right? So it could be labor demand, could be labor supply, could be the production function shifting up. It's all those things, right? So the question is what? So now, right? The homework question, for example, and what current real world events, right? Right. So is infrastructure spending, right? So if that happens, then you increase the quality of roads, bridges, etc. You don't and that might seem like a trivial thing, but it means that trucks don't break down as easily, or ports. You dredge ports, you make bigger, more efficient ports, so goods can get from container ships to the middle of the country or other parts of the country more easily and quicker. So
labor demand,
all of those kinds of things. That will increase labor demand, artificial, so one of the things we talk about earlier in the course, right, is artificial intelligence, machine learning, that kind of technology. The sort of initial thought is that, well, that's going to replace labor, but the reality is that that increases the amount of employment, but who's employed and in what areas changes, right? Because you don't need people, you're not going to need as many accountants in the future because that's going to be done by artificial intelligence and machine learning. Some of the basic accounting, right? Or you don't need as many here's an easy one. You don't need as many tax preparers now, right? Because you got really good tax software that like anybody can use, right? The same thing for, you used to have to, back in the day, like this is ancient history for you all, right? You used to have to go through a travel agency to get airline tickets, right?
Wow.
Yeah, you had to talk to this person to get this airline ticket. Well, we don't do that anymore. Well, rarely. Some people do. They're still around. We don't need, you don't have as many of them as we did before, right? Because we got Orbitz and we got, Kayak and we got, you know, Expedia and whatever, right? So two things, and then Janine, I'm going to come back and we'll go through one. So long run trend tends to be going up, and then around that are business cycles. So let me go back before we get started with actually doing a problem. Let me share a screen and go back and do kind of what we're doing before you came on, Janine. Let's look at Fred. And I want to make this point. I usually, this is one of the first things, and I come back to it at the end of the semester again in class, when we have a face-to-face class. One of the first things I do on the very first day of class is bring in a picture that I'm going to share. All right, so let's go here. So let's go to Fred. And let's search Fred and let's put in real GDP. So there's real GDP. So what do you notice? What do you notice about that graph?
It's obviously real GDP has been increasing.
That's the
since
trend. So
1950.
that's the trend. That's the trend. Right? That's the trend we're talking about. But it hasn't just been going up. Sometimes it actually goes down. So let's narrow in the view. Let's bring it up to, let's say here. All right. Let's bring it in this last 25 years or so. All right. But it doesn't always go up. Sometimes it actually goes down. Right. All right. So sometimes it actually goes down. Those are recessions. That's why this is shaded. The shaded areas are recessions.
And what do you think caused those, the ones we're looking at? Because I don't remember anything significant going on with those.
2008, 2009, that was the housing crisis, coronavirus over here, right?
Right.
2000, this is a pretty mild one. So I don't recall exactly what just kind of caused the slowdown there. I actually don't recall that myself, because it was pretty mild. It was kind of an interruption of the growth, but so, and it was also pretty short, right? So that's another thing that you see, and this is discussed in the text, right? What do you notice about these? There's actually a whole section in chapter 8 about this, right? And a table. There's a table. This is the graphical version of that table. So these shaded lines, these shaded areas are recessions, right?
Right.
The white parts are expansions. Recession, expansion, recession, expansion, recession, expansion. To make your point about, yes, we have these recurring cycles, right? I'm just using real GDP as one variable. We could put up consumption spending, we could put up different variables, and we'd see a similar kind of pattern by and large. So employment would look similar. So what do you notice about hold on just a second. What do you notice about the white versus the shaded areas?
We have much more expansion.
Yeah. So much longer, expansions are much longer than, but what about back here? What about back in the 1940s, 50s, and 60s? What's true there?
Seems like they were having a little bit more contraction.
Yeah, so question, right? A question that should pop out of your mind is to say, like, why are the expansions so much longer out here after, say, 1960-ish, right? Why are the expansions so much longer relative to, and the contractions are maybe about the same length, but why are the expansions so much longer than they were prior to 1960? And if we could, and if you look back in, this is another section that's in chapter 8. Go back and look at that, right? And you can go back 1900s, 1800s, 1850s or so is when we started measuring business cycles, or we have data to go back that far. And that was the case. So it's not just like this period. If you go back in time from here, you'll see a similar kind of pattern. So why did I bring that up? Because macroeconomic policy. That's the key. That's in a word, that's what's done. So macroeconomic policy, changes in government spending, changes in taxes, changes by the Federal Reserve in real interest rates or nominal interest rates, what they have helped to keep the economy operating close to full employment. Right? That's what it means to be. That's what it means to be in an expansion, is that you are not. What the recessions are periods, negative periods below full employment or potential GDP.
Okay, but before 1960, we didn't take out as much, nationwide debt. Our government wasn't taking as much debt.
That's partly true. That's not completely true. That for the war, for example, they certainly did. World War II, World War I, etc. Things like that. You usually see debt going up significantly because they got to pay for the war effort, right? To get troops somewhere, to buy, equipment and armaments and all that. But when was Keynes writing? Right about here. All right, 1946. John Maynard Keynes wrote his big opus in 1940s. He was responding to the 1930s. Okay, but it was only about 1960 when they started to take Keynes's views seriously. I mean, in the sense of really driving macroeconomic policy. So this was the first pretty long expansion. This is during the Kennedy era, right in here, right? And Vietnam War, and government spending was, and so there were tax cuts and increases in government spending. Yeah, that's going to be expansionary, right? So here's the thing. I could take a picture like this, or take a period of time. Or I could take a couple of pictures of this. I could take a couple of time series and have diagrams, and for example, tomorrow, and I could say, explain what could cause that. All right. Now there may be multiple answers to that. All right. But there are some answers that are not right, right? So if you saw, and so the question is, where do the shocks come from, all right? So if we looked at this period right in here, during this recession, for example, and this one too, in the 1970s, but this one in particular, this recession, and this shorter one in 1980-81, okay? So this is when I was in junior high and senior high, graduated from high school. No, I'll graduate from college about there. But what was happening there? Big oil price shocks. Oil prices went up significantly. Gasoline prices went up, quadrupled. It was so there was high inflation and high unemployment. You can't get that with an aggregate demand shock. You can only get that with an aggregate supply shock. So you should, so what I'm saying is, to really study this well, and I haven't forgotten your question. I'm coming back. That's what we're gonna do. All right. You should be able to say, like on the homework, here's something that's happening in the real world. Show me the economic theory behind that. Right, in terms of the graphs, in terms of our model, and then should be able to go the other way too. I can tell you, I could show you some data, and you should be able to develop the economic model to explain what's going on. Right, that's the name of the game. That's what economists do. That's exactly what they do. Try to develop models to explain what's going on. And so can our models explain these ups and downs in real GDP and other things? That's essentially what chapter 8. That's really what chapter 8 is there for. So I'm going to stop sharing this. All right. So I'm going to share different screen. Oops. Let's see. Okay. You want to pick something, Janine? So do you want to work it through? Want to work through the model? Want to work, you know, give me an example?
Infrastructure plan that Biden's working
Oh
on.
yeah, the infrastructure.
Okay.
That was on the homework.
Yes. So
That has to increase labor.
hold on. Let's work it through piece by piece incrementally. That's what we do. That's what economists do. That's what you do as a budding economist, right? You don't jump to the end. We figure out what the model tells us, and then we see whether that goes along with what we sort of are thinking it should be. Right? So first of all, we need to put all the pieces in place, right? So what do we have in our model? Well, we have ISLM. FE. All right, real interest rate, real GDP, and we have aggregate demand, short run aggregate supply, long run aggregate supply. Always label things, because otherwise things get messy and get things, don't remember where things are at. Price level, real GDP. So this is potential GDP. I'll call that Y0. I'll do it that way. It's potential GDP. Here's the, call that R0. That's where this is P0. That's our starting point. All right. So here's an economy in general equilibrium. All the lines are crossing a single point where A is. Right. Now, underneath this, right, what else do we have? We've got the production function. And we have the labor market. All right. So this is back from chapter 3. Right. So this is chapter 3. Labor demand, labor supply. Where they cross, right? That's full employment. That's related to A. So here's the amount of employment at full employment. Here's the real wage. Start with at full employment. Production function has output, and so we can just go straight up from there. There's the amount of employment from the labor market. And plug that into the production function with a given amount of capital and technology. And there's how much, or here, do it this way. There's how much can be produced at full employment. That's that right there. Okay. So there's a production function labor market. Now, we have the goods market. Yeah, sorry. That's where we're going, right? Desired investment, desired saving. Let's put the zeros there. So we're measuring investment and saving on that axis, the real interest rate on this axis. So when we start, there's the amount of investment, there's the amount of saving, right? They're equal. And there's the real interest rate, which has to be the same real interest rate as here, because that's where this comes from. This IS curve comes from that graph, right?
And we have to do this just about every question where you ask.
That's correct.
Man, it's a lot of work.
It's a lot of work. It's the whole course in a nutshell. That's where we're building up to. All right. So here's the money market, asset market. There's the price level, the level of money supply or money. Well, this is money demand. This is money demand. This is the money demanded. All right. There's the real money supply. And so this is real money supply. There's the real interest rate. And that real interest rate is got to be the same as that one and that one. There can't be, and nothing can't be inconsistent. They're all tied together, right? Because the point we're at at point A is equilibrium in the goods market. Boom. That's the IS curve, right? That IS curve has to do with the goods market. We're in equilibrium on the LM curve, right? That has to do with asset market, right? So labor market, goods market, asset or money market, right? That's our starting point, right? So we haven't done anything yet, right? There's our model. That is the whole shoot and match. That's the whole course right there, all right? This is chapter 4. This is chapter 7. This is chapter 3, as we said up here, all right?
So when it's in a good, when it's just, hold on. Oh, you got those two mixed. No, you didn't. No, you didn't. No, you didn't. You usually, I feel like you usually with the goods market on the bottom and usually with the asset market on top of it. But okay.
Sometimes I do, sometimes I don't. It doesn't matter how you
It
draw them.
doesn't.
Actually,
It
it doesn't.
doesn't.
It's okay. It's not like there's not like a rule about that, right? But
Right.
I will say this, right? So what we've done is I will put right now, I'll just kind of put a line across here. Point out that the stuff up on top is like the whole economy. This is what's underneath that, right? Right. So for example, IS and LM together, right, become aggregate demand. That's how you get the aggregate demand curve. So this is boiling things down even more. So that's why we start with the ISLM and FE. The FE curve comes from the labor market and the production function.
Right.
All right. So the only thing that's going to, so the point is the only thing that's going to shift FE, right, is something that either shifts labor supply or something that shifts the production function. Okay. All right. Now let's take this question. So question is an increase in infrastructure spending.
Government spending, correct?
Yeah, government infrastructure, federal government infrastructure spending. Okay, so that's our example here. All right. And if you look at the solutions, the homework that I posted yesterday, you'll see all these, it looks like this. It look like this, right? So let's see. I guess the purple shows up well enough. Maybe I can do that, or I can use red. Let's see what's here. Oh, let's do that. All right. So in the homework question, there are two things. All right. I mean, I tell you this. Well, because there are two things that are going to happen here, right? So infrastructure spending. Well, one of the things we know for sure, government spending is going up, right?
Right.
Right. So that by itself does what? Reduces national saving. Okay. So in the goods market, that's going to happen. Due to the government spending increasing.
To goods market.
So what happens to the equilibrium real interest rate in the goods market? It's now higher. For a given level of GDP, the equilibrium real interest rate is higher. For a given level of GDP, the equilibrium real interest rate in the goods market is higher. That's an upward shift in IS.
And what's that little function or whatever that you make? It's like SD equals C
yeah, except we just have a closed economy here. It's just S equals I right now. That's what it means to be in equilibrium, right? That's right. So call this I, S1, I1, and R1. Right? So this doesn't have to be step one, but I'm calling it step one, right? So this shifts to the right because of government spending going up. So anything that changes something in the goods market is going to affect IS. Right?
Correct.
So those are connected. That anything that has to do with IS has to do with spending. Spending, consumer spending, firm spending, or government spending. Also, well, and you could say, well, what about taxes? Well, they change consumer spending, right? So, and they also, well, they will change it, and interest rates affect the LM. That's down here, the LM. So, the Federal Reserve. So, federal government or consumer spending, that's the goods market. Federal Reserve, that is the asset market. That's the LM curve, right? So,
Right. So
the IS curve has to do with C and I and G. And taxes affect consumption, and so that's there too. The ILM curve has to do with the price level and the Federal Reserve. Bottom line.
So LM has to do with what's the P stand for? Price?
Yeah, price level, CPI, Consumer Price Index.
Price, the Federal Reserve, and what else?
That's it. Price
And
level and the Federal Reserve.
And Federal Reserve will basically be interest rates.
Yeah, down here, changing the money supply, real money supply.
That's just interest rates.
Yep. That's it. So this is B that goes along with this B right here.
And C is for consumption, I for investment.
Actually, B is up here, but
and S is for saving.
Yeah. Yep. Back in chapter 4. Now, so that's part of it, right? Spending goes up, but I also tell you in that problem that it's also going to have an impact on infrastructure. The whole point of infrastructure is that it has a long run impact on the economy as well. All right. So an increase, better roads, better bridges, better technology, more education, a more highly educated populace, all of those things, right? So the same amount of labor with the same amount of capital and technology can now produce more. Essentially, it's an increase in human capital. Well, it could be actually real capital or human capital. So the other part of what happens, right, with infrastructure spending, which is different from other kinds of government spending typically, not always. If you're spending money on Head Start, for example, preschool program, right, then that's going to have an increase in human capital and increased productivity down the line as well. It's one of the reasons why they do that. When we move to universal free K through 12 education in the US, right, that was government spending. It was aimed at increasing the production function, right, to increase economic growth, right? So
do you think free colleges would be free colleges would be much more affordable than paying for the elementary schools and all that stuff?
Well, you need both, right? You need both.
I mean, ideally, but we don't have to make colleges free, because I feel like if someone really wants it, they can take out loans.
Right. That's why we go to the ballot box, right? That's a question. That people should, there should be economists like you in the future doing research on that to say, one area of research could be, where do we get the biggest return for $1 trillion in government spending, for example, right? And then say, well, because we have choices, right? We could put it into healthcare research. We could put it into roads and bridges. We could put it into K-12 education. We could put it into college education and community college education, right? And people need to do research about that to find out kind of what leads to the best outcomes. There's no clear answer to that, right? So there's not one right answer to that. So so the increase in infrastructure is going to tend to shift up the production function, right? So if this was
but wouldn't it have to start in the labor market first before it affects the production function?
No, kind of they go together. They go hand in hand. Right. So this allows, so let's say, so here, let's say, so one part of the infrastructure spending is increasing broadband access to people in rural areas. Right.
Right.
It kind of like electricity. Like people in cities had electricity before people in the country had it. Right. But electrifying a whole country was a huge deal for increasing productivity, because now if people can work longer because they have lights in their houses, and even smaller towns. I mean, smaller towns could be 100,000 people, 100,000, or it could be 50,000 or 12,000 or whatever,
And that's
right?
probably why we're seeing these expansions, those wider period expansions, because more productivity.
Well, that's part of it. It's not the only thing, but probably more so having to do with, I mean, that's part of it, but also that has, so the question, we'll come back to that. The question there is it long run aggregate supply shifting out, or is it aggregate demand shifting out, or is it both? Well, no, it's both, but, you know, we'll come back to that. We can come back to that. Right. So this is going to, so let's say you increase broadband access, right? That's going to increase the amount of output that could be produced with the same amount of workers in the economy, right? At the same time, it's increasing the marginal product of labor, right? Individual workers can now produce more output. They're more productive. So yes, that's going to increase labor demand. So that's going to move us out here, right? So oftentimes there could be examples where there's only one thing happening. This one's a more complex one because there's both a demand side and a supply side impact from infrastructure spending. So what happens? We move from there to, I'm going to call it C. You'll see why.
It wouldn't be B, or you just gonna jump to
No,
C?
no, you're going to see why. No, it wouldn't be. It won't be B, because you're going to see why. Just hold on to that. So that's a new level. I'll call it Y1, potential GDP. Right. So that's higher. So that's like Y1 potential. Right. And I'm drawing it to the left of B. There's a reason for that. In the example, I tell you the spending impact is probably greater than the long run.
I have a question.
In the short run, it's going to be bigger. Yes.
So why is that a labor demand shift and not labor supply?
Because when the production, we learned this back in chapter 3, when the production function shifts up, right, here's the slope of the production function.
Mhm.
All right, what's happened to the slope? It's increased, right?
Cool.
It's tilted up, right? Production function has tilted up. Production function has now got a steeper slope at N0. The slope of that is the marginal product of labor. The marginal product of labor is now higher at N0.
Okay.
All right, to move along the labor supply, not a shift in the labor supply. Labor supply has to do with decisions about leisure, how much leisure to consume. It's affected by changes in tax rates, maybe that sort of thing. And yes, there'll be an increase in the amount of labor supplied, but to move along the labor supply curve. Doesn't shift. For a given real wage, workers aren't willing to work more hours. They're willing to work more hours because they get a higher real wage.
Okay. My brain was confusing labor supply and labor demand, meaning like labor supply is like what's available. But now I realize my brain kind of had that wrong.
Well, there's more available as the real wage goes up.
Mhm.
As firms offer higher wages, there are going to be more people willing to supply more, but supply more hours. Either they weren't supplying before, now they come back, right? Because the opportunity cost of leisure has gone up.
Mhm.
Price of leisure has gone up. So the spending impact, especially in the short run, is going to be bigger than the
But
product.
how does I can understand demand going up because you're gonna need more people going to work because we're expanding. We need more labor. So, but I don't understand how price how what like the wage price. I mean, I guess if you're paying people more, they would want to work more. There'll be more influence to work, but I don't think this bill necessarily guarantees that people will get paid more. I
They
think it just
absolutely, absolutely
that
will.
they would
They
need more
absolutely,
workers.
people will absolutely get paid more. Now, it doesn't mean every individual gets paid more. It means there are going to be more jobs with higher wages
Why?
because there will be a labor shortage otherwise. There'll be a labor shortage. The economy is going to expand. You're going to have people, engineers, you're going to have computer software engineers, et cetera, right? So people with college educations as opposed to high school educations, right?
But
So
those blue collar workers who gonna work on those interstates and
and they will have higher wages too. They'll be working overtime. They'll be doing other things like that. The other construction workers, they'll be so overall they'll get higher wages because there's more demand, right? There are only so many workers around. They're they're not going to get higher wages right away necessarily, right? But one of the things that we saw over the last 10 years or over the past 4 or 5 years is real wages started to increase. Why? Because we're at full employment, and to get workers, you got to offer higher wages. So prior to
right.
the pandemic, like the unemployment rate was 3.5%, right? So to get construction workers, if you own a construction company and you're looking for construction workers, good luck with that. Like they were
Right.
all working, right? And so to get more workers, you got to offer higher wages than your competitor, right? So were wages going up? Absolutely, they were. Everybody was benefiting from that, which is part of the argument for pushing aggregate demand that Janet Yellen makes and other people make, is that you have an economy that's close to full employment or beyond full employment, then that helps everybody. Rising, that's argument is a rising tide lifts all boats, but we know that that's not necessarily true. Yeah.
So do we need more people? No, not necessarily.
Well, there are going to be more people working because more people are going to be attracted to work because the wages are going up. And some people are going to say like, oh, it's not worth it for me to sit at home. Or people who are on the sidelines are going to say, oh, yeah, there are jobs available. I'm going to go out and get a job, look for a job.
All right.
Yeah. Let's work this through. Because we're going to get mixed up with things otherwise. Let's keep the thought process going on this. So now we're at a place where okay, we've taken account of the increase in government spending, the spending side, the IS part, the national saving part. We've taken account of the longer run impact on the productive capacity of the economy because of infrastructure spending, right? So now the question is, so that's the shock to the economy, right? Right. So we started out in full employment in general equilibrium. Now we've run through what the impacts are, right? In the goods market, the spending side, the increase in productivity and in productive capacity of the economy on the supply side, right? Over here, an aggregate demand, in terms of aggregate demand, aggregate supply, the FE and long run aggregate supply they're the same. They're the same thing. They mark full employment. So long run aggregate supply has shifted to the right. I'll call it Y1 potential. All right. Aggregate demand, right? Aggregate demand is where IS and LM intersect. That is beyond potential GDP. So it has shifted to the right, right? And so this is point B. This is the point B over there, right?
Why is LRAS shifting to the right?
Long run aggregate supply curve shows the full employment, how much output you can produce at full employment.
Oh,
The FE curve shows how much output you can produce at full employment. They're the same curve. One just
okay.
has P on the axis, one is R. They're not affected by P or R. They're affected by technology. They're affected by human capital, education. They're affected by the labor supply, immigration, for example, labor supply, birth rates,
So
for example, with labor supply, right?
Right. FE and the long run aggregate supply
Same
are
thing.
when they move the same way.
Absolutely, 100%. They have to, right? Because we're measuring Y on the axis. It's just a vertical line. The long run productive capacity of the economy, in other words, right? The long run productive capacity of the economy is determined by the stuff we learned about in chapter 3. Is the price level in there anywhere? No. Well, it's here. It's W nominal wage divided by the price level. But the argument is that the price level is flexible so that nominal wages move with the price level. The real wage doesn't change with changes in the price level. So this has nothing to do with real interest rates, has nothing to do with the price level, right? So this box right here, we learned in chapter 3, is kind of a separate deal in a sense. It's just, that's the FE line. That's the longer average supply curve line. They're the same thing. But they're the same exact thing. They mark exactly the same thing, right? Just one has price level on the vertical axis. The other one is the real interest rate. Okay.
And this is kind of going backwards, well, a little bit. So why doesn't the FE curve shift to where it's at equilibrium?
It could. I mean, it doesn't shift, but so we have 3 choices when we do this very specific question. Aggregate demand shifts further than potential GDP. Aggregate demand shifts less than potential GDP, or aggregate demand and potential GDP shift exactly the same amount. Right? Those are the 3 choices. Like if they shifted exactly by the same amount, like that would be a 1 in a million chance. Right? But it could happen, right? So I'm setting up the example to tell you, I'm telling you in this example, right, that aggregate demand is the spending impact on the economy is bigger than the productive capacity impact on the economy. I think that's absolutely true. And why is that? It's because it takes a long time to get infrastructure in place. It takes years. The spending, however, right, happens, right? The paying workers to build new roads or repair roads, that's money in their pockets like now, right? And that increases spending. So the spending impact of this is immediate. It's a win-win, right? Infrastructure spending is a win-win, as if you're willing to go into debt for it, or you're willing to raise taxes for it, either one, right? But that is a separate issue. In terms of actually doing it, right? You get an immediate boost because it puts people to work doing stuff, or it puts people in college, or whatever, however the infrastructure spending is set up, right? And the longer term, it starts to increase the productive capacity of the economy. So one form of infrastructure spending is spending more money on college education or Head Start in the preschool level, right? So when the government started the Head Start program, right, that was an investment that wasn't going to pay off for 20 years at least, right? Those students, the whole idea was you get more students in school, graduating from high school, and hopefully going to college. Like, you weren't going to see that productive capacity of the economy increasing for a long time, right? But once you get that going, then it's a continuous process and it keeps happening.
So the train of thought was that preschool definitely helps. Kids who go to preschool have a higher chance of going to college.
Absolutely, 100% on that. Yep, that's right. Investment in there have been big studies on this. The cost benefit analysis of Head Start, huge payoff. Huge payoff. It's more than paid for itself many times over. Yep. Yep, exactly. All right, so part 1 was, okay, we start out in full employment in equilibrium. Part 2, how do we show what's happening in this particular example? Part 3 is we're not at full employment anymore, right? Because aggregate demand, short-run aggregate supply aren't intersecting where long-run aggregate supply is. ISLM are not intersecting where the full employment line is. So what happens? How do we get back to full employment?
You got to raise the price,
Prices adjust.
or your
Prices
price has
adjust.
to change.
Prices adjust, right? So
Mhm.
what's going to happen? Price is going, where aggregate demand is greater than aggregate supply. We're beyond full employment. That graph from Fred, like we are above the long run trend. This is
So
like,
if we lower the
this is like,
price,
this is like 3 at point B, this is like 3% unemployment rate, really low unemployment rate, right? If we think of full employment as being somewhere around 4% unemployment rate, we're beyond that, lower, right? That's what that means to be at a point like B. What's going to happen? So there are labor shortages. Yes, wages are going to start, but prices are going to start to go up. So what's going to happen? LM curve is going to shift. The LM curve is always the one that does the shifting. Well, I mean, if we just let it go, right? It's going to shift back to the left till we get to where? Point C.
to the equilibrium.
The equilibrium.
So the LE curve will always get us back to the equilibrium.
Yep.
Always.
Always. I'm going to explain that. Hold on to that thought, though. The price level is going up. So over an aggregate demand, aggregate supply space, what's happening? Short-run aggregate supply curve is moving up. That's what it means for the price level to increase, right? Till when? Till all the curves line up again, right there.
Now this never
So-
happens in real reality.
Oh, sure it does. Sure it does. Absolutely does. Now, so the question, so if you get beyond, so here's, and this is the way, so this is the way it shows up in the Wall Street Journal and the news and blogs and Twitter, wherever, right? This is the way it shows up. This is the headline. These are the headlines. This is how it goes. Oh, economy booming, unemployment at record lows, Federal Reserve's worried about inflation. All right. So what tends to happen is that inflation. Now, so the question isn't whether it's going to happen. The question is, how long is it going to take? If you're a Keynesian, you believe that prices don't adjust very quickly, and you can be out here at B for a long time. You can be at B for a long time. Actual level of GDP is higher than potential GDP. All right. So there's the actual level. IS and LM, aggregate demand, short-run aggregate supply, determine the actual level of GDP at any point in time. The potential GDP line is just a marker of full employment. Right. It's the trend line. It's a trend line for real GDP, potential GDP. Doesn't mean we're not always there. We can be away from it. Right. That's the point. And if you're a Keynesian, you believe that, all right, no, there's not going to be much impact on prices. It's all going to be on real GDP and employment. So you believe that employment's going to increase. Unemployment rate's going to go down. You're not worried about inflation. Now, if you're a classical, you say, whoa, no, prices are going to go up. We're going to have inflation. This is going to start happening. We're going to be back towards C. Like, so how can you avoid the inflation? Well, the Federal Reserve can push the LM curve back, right? The Federal Reserve can push the LM curve back by doing what? Raising interest rates, by reducing the money supply, right? That will raise interest rates, and that will actually if we carried out the rest of this, I didn't do that before. As real GDP goes up, real money demand goes up, right? As we go from A to B, real GDP was going up. That by itself pushes the real interest rate up, right? Call this R1. That's this R1 right here. That's this R1 right here. Now, at the same time, the price level now has gone up, right? In response, this is the move from B to C. And so what happens when the price level goes up for a given money supply? The real money supply gets smaller. This shifts to the left, and we end up back here at R2. Boom, it's C. This is like C, right?
I
This
have a
is,
question.
this is B. So, yeah, go ahead.
So, this is with the SRAS curve. So that moves with the LM curve.
Aggregate demand?
No, the short run aggregate supply.
When the price level is moving, what's underneath the way that story was, if you're beyond full employment, then the price level is going to go up. If the price level goes up, that reduces the real money supply, that increases real interest rate, that shifts the LM curve left. Aggregate demand, aggregate supply, as the price level goes up, short run aggregate supply curve goes up. Yes. But if there are two things that can cause the LM curve to shift, right? Federal Reserve can change policy too, right? So if you don't want it, so if you're worried that pushing the economy too far is going to lead to inflation, right? That's the worry by some economists sometimes, depending whether they think prices are flexible or not, or how flexible they are, right? And so, and how far they think, like we can't actually see these curves, right? These are figments of our imagination, but there's theory that tends to be consistent with the actual behavior in the economy, or they can't just be figments of our imagination totally, right? But we can't actually, we don't like, is that line really there, or is the line really out there? Economists spend a lot of time. This is what a number of the economists at the Board of Governors of the Federal Reserve, also at the Bureau of Labor Statistics, also at the Congressional Budget Office, they're trying to figure out where potential GDP is, because that matters for what you think is going to happen to inflation, right? We don't know that with certainty, like we pretend here, all right? But we know that that's generally going to put upward pressure on prices. If the economy is beyond potential GDP, what the Federal Reserve can do instead is say, oh, reduce money supply, rather than waiting for the price level to change. We're going to reduce money supply. We're going to raise interest rates ourselves, right? And that pushes the LM curve back. In that case, that pushes aggregate demand back. So if the price level changes, LM and short run aggregate supply change. If the Federal Reserve carries out monetary policy, the LM curve changes, but aggregate demand changes, because that changes the place where the IS and LM intersect. That changes the LM be cut through policy. Changes in policy, government spending, taxes, Federal Reserve change aggregate demand. Price level changes short run aggregate supply and the LM curve. So in the end, in the end of all this, where do we end up? We end up at point C. So in this case, as real GDP is higher than it was, we're going to end up here at point C. So this was R1. This is going to be R2, right? Everything has to be consistent. We got to end up in the same place everywhere, right? And we can't have like the R being different here than it is here, or here. That's what it means to be in general equilibrium. They all got to be consistent. So in the end, what happens, right? At point C, employment's gone up. The real wage has gone up compared to where we started today, right? The real interest rate is higher. In this case, the way I've drawn this, right? You could make an argument here, and you'll see it in the solutions to the homework for this question. You could make an argument that desired investment also is reduced is increased because of the idea that the expected future marginal productivity of capital is higher. So this could happen as well, right? That just means R2 is here rather than there, right? So that could be C, right? Then it depends, is the change in desired investment, does that shift bigger than the one in desired investment saving, decline in desired saving? We don't know that for sure, but so the change in I, we're not sure. Change in S overall, we're not sure. Probably they may have, but the higher real interest rate is what crowds out private investment. That's the concern about budget deficits, right? Is that they lead to higher real interest rates in the economy. Real GDP has gone up, all right, and the price level has gone up, all right. So in the end, that's what we would expect to see from that kind of infrastructure spending. So the analysis that the Congressional Budget Office does for this kind of thing, which it does for any president, they will look at the long run economic implications of things like an increase in whatever the policy is, right, that Congress is looking at. They will do the analysis and they'll use the econometric models, which essentially mimic this, right? Yeah, this is what they do. They do exactly this, except they use more sophisticated models, but the general idea is the same, right? We're doing it graphically. They do it econometrically, but those econometric equations are based on these kinds of theoretical relationships. They're not separate from that.
So what exactly happened in the asset market?
So the asset market, all right, down here, all right. So as real GDP went up from A to B, right, because of the spending increase, right, IS shifting to the right, that increases demand for money. That tends to push the interest rate up, right? I'm sorry, this was B over here, all right. All right, so the real interest rate's higher. Now, as the economy adjusts and the price level goes up because we're beyond potential GDP, then the price level is in the denominator of the real money supply, right? If that's going up, the real money supply is decreasing. So here's the new money demand, here's the new money supply. And so that's shifting to the left, not because of Federal Reserve, because of price level, right? And the real interest rate is going up to R2. And we're back at C, right? So A to B to C, A to B to C, A to B to C, A to B to C. And I'm leaving off the B here because in the short run, that just doesn't make any sense for classical economists. And you can't show B here. In the Keynesian model, that's what we're talking about, A to B. A to B is before there's any price level change. That's essentially the Keynesian model. Right? The Keynesian model, you take away the labor market. The labor market it doesn't function like this. The labor market's out of equilibrium. The labor market, the assumption is that the labor market has a surplus of labor, and all that matters is there's more demand. So in the Keynesian model, there's more demand for goods and services. Firms can get as much labor as they need to produce that level of output. That's the assumption. The labor market just doesn't work the same way for Keynesian. They don't believe that the real wages adjust quickly, right? And so you're just out of equilibrium. So if we did chapters 10 and 11, we would go through the story about how newer Keynesians in the last 20, 30, 40 years, what story they've developed to be able to explain that, right? Something called efficiency wage theory, and why there's a surplus of labor, why you have unemployment, etc. Right? So in the classical model, you never have unemployment, right? You're always at equilibrium. So the classical model, it's hard for one of the problems it has is trying to explain that business cycle fact, that unemployment rates change over the business cycle. Okay. So that's that equation. I've got a an advising session coming up in 9 minutes. So we're about 20 minutes over our time, which is fine. But that's how you go through. So this is this is a pretty this is an extensive kind of question. But the real world is like that. This has got two things going on. The change in government spending for infrastructure has both a supply side and a demand side impact. So in that case, you've got to do both. But we have the tools to do that. Okay. So I will be back tomorrow at the same time if you want to discuss more questions related to this chapter. All right. In the meantime, I would take a look at the solutions, the homework. Read through the text for them, and try to follow along on the graphs like here, but to try and follow along on the graphs while you're reading. So kind of keep the graphs separate and see if you can follow the way through. And if there's a point where you can't do that, then you got to sort of back up and think about, like, well, why does this happen? Why did he say this? Why is this happening? That's actually a really useful way of studying. So I've given you a number of, on the homework, there are actually a number of different examples of different kinds of shocks to the economy, different kinds of things that knock the economy out of equilibrium. And so they're slightly different. So that's why it's useful to look at those. At the end of the day, you should be able to think about, it's like multiple choice. There are really only a few things that I can really ask. Either at the end of the day, there's a shift in aggregate demand to the right or to the left, or there's a shift in longer aggregate supply to the right or the left, or both. That's it. And that's it. Now the question then is, well, is the shift in aggregate demand due to a shift in IS or a shift in LM? I mean, but those are details, and those are important details. But at the end of the day, there are only so many things. Or you could start with the ISL MFE if you want, and you could say, well, okay, either there's something happens. It's either got to be a shift in IS to the right or left, a shift to the LM right or left, or a shift in FE right or left. Only 6 things that can happen, or some combination, or it could be FE plus, like in this example. But really, there are only 6 things that can happen. And you should be able, so you should, in terms of studying, you should go through each one of those 6. What if there's an increase in IS? What if there's a decrease in IS? What happens? What if there's an increase in LM? What happens? What happens if there's a decrease in LM? What happens? So what if there's a change in FE? What happens? Right? And if you do that, then all of these kinds of examples are just one version of those. And in fact, if you do that, those are your notes. You can you have at the exam, right? So it's really useful.
Where can we find that? Or do we just kind of need to guess in a sense?
What's that?
The things that affect the IS, the FE.
Those are all in chapter 9. They're all listed there.
All the different changes.
Yeah. It's changed. So what are the things that change IS? Change things that shift I, or things that shift S, right? Chapter 4. Right. What are the things that shift the FE curve? Aggregate production function, labor market. Chapter 3. All right. What are the things that shift the LM? Asset market. Chapter 7. All right. So yeah, it's as simple as that, but that's as complex as that as well, right? So going back and understanding that those things that shift and understanding like, oh, that's tied to that chapter back there. Well, that's tied to that chapter. That's why we did that chapter. That will really be, that's really helpful. All right, I'm gonna need to break off here, and I will see you maybe again tomorrow. Well, I'll be here tomorrow, but all right. All right. Have a good rest of the day today.
You as
All
well.
right.
Bye-bye.
All right.